Hello guys, today talk about insurance policy, long-term care insurance basics. Long-term care insurance pays for services to help individuals who are unable to perform certain activities of daily living without assistance or require supervision due to a cognitive impairment such as Alzheimer's disease. Features of long-term care policies. The best policies pay for care in a nursing home, assisted living facility, or at home. Benefits are typically expressed in daily amounts with a lifetime maximum. Some policies pay half as much per day for at home care as for nursing home care. Others pay the same amount or have a pool of benefits that can be used as needed. Criteria for the beginning of payments. The policy should state the various conditions that must be met. They can include number 1, the inability to perform 2 or 3 specific activities of daily living without help. These include bathing, dressing, eating, toileting, and transferring, or being able to move from place to place between a bed and a chair. Number 2, cognitive impairment. Most policies cover stroke and Alzheimer's and Parkinson's disease, but other forms of mental incapacity may be excluded. Number 3, medical necessity or certification by a doctor that long-term care is necessary. Most policies cover stroke and Alzheimer's and Parkinson's disease, but other forms of mental incapacity may be excluded. Number 3, medical necessity or certification by a doctor that long-term care is necessary. Most policies have a waiting period or elimination period. This is a period that begins when an individual first needs long-term care and lasts as long as the policy provides. During the waiting period, the policy will not pay benefits. The policy pays only for expenses that occur after the waiting period is over if the policyholder continues to need care. In general, the longer the waiting period, the lower the premium for the long-term care policy. Benefit periods for long-term care may range from 2 years to a lifetime. Premium can be kept down by electing coverage for 3 to 4 years longer than the average nursing home stay instead of a lifetime. Most long-term care policies pay on a reimbursement or experience incurred basis up to the policy limits. In other words, if the policy has a $150 per day benefit but the policy holder spends only $130 per day for a home, a long-term care provider, the policy will pay only $130. The extra $200 to $20 each day will, in some policies, go into a pool of unused funds that can be used to extend the length of time for which the policy will pay the benefits. Other policies pay on an indemnity basis. Using the same example as above, an indemnity policy would pay $150 per day as long as the insured needs and receives long-term care services regardless of the actual outlay. Inflation protection is an important feature, especially for people under the age of 65 who are buying benefits that they may not use for 20 years or more. A good inflation provision compounds benefits at 5% a year. Without inflation protection, even 3% annual inflation will over 24 years. reduce the purchasing power of a $150 daily benefit to the equivalent of $75. Six other important policy provision. Number one, elimination period. Under some policies, if the insured has qualifying long-term care expenses on one day during a 7-day period, he or she will be credited with having satisfied 7 days toward the elimination period. The time between an injury and the receipt of payments. This type of provision reflects the way home care is often delivered, some days by professionals and some days by family members. Number two, granted renewable policies. These must be renewed by the insurance company, although premium can go up if they are increased for an entire class of policyholders. Number three, waiving of premium. The provision ensures that no further premiums are due once the policyholder starts to receive benefits. Number four, third party notification. This provision stipulates that a relative, friend, or professional advisor will be notified if the policyholder forgets to pay a premium. Number five, non forfeiture benefits. These benefits keep a lesser amount of insurance in force if the policyholder lets the coverage lapse. This provision is required by some states. Number six, restoration of benefits. The provision ensures that maximum benefits are put back in place if the policyholder receives benefits for a time that then recovers and goes for a specified period, typically 6 months, without receiving benefits. Disability insurance basics. Disabling injuries affect millions of Americans each year. Disability insurance, which complement health insurance, helps replace lost income. If an individual is unable to work due to disability, there are three basic ways to replace income. Number one, employer paid disability insurance. This is required in most states. Most employers provide some short-term sick leave. Many larger employers provide long-term disability coverage as well, typically with benefits of up to 60% of salary, lasting for a period of up to 5 years until the age of 65, and in some cases extended for life. Number two, Social Security disability benefits. This is period to workers whose disability is expected to last at least 12 months and is so severe that no gainful employment can be expected. Number three, individual disability income insurance policies. Other limited replacement income is available for workers under some circumstances from workers' compensation if the injury of illness is job related, auto insurance if disability results from an auto accident, and the Department of Veterans Affairs. For most workers, even those with some employer paid of coverage, an individual disability income policy is the best way to ensure adequate income in the event of disability. Workers who buy a private disability income policy can expect to replace from 50% to 70% of income. Disability benefits paid out. An individual disability policies are not taxed. Benefits from employer paid policies are subject to income tax. Types of disability insurance. There are two types of disability policies: short-term disability and long-term disability. Short-term policies have a waiting period of 0 to 14 days with a maximum benefit period of no longer than 2 years. Long-term policies have a waiting period of several weeks to several months with a maximum benefit period ranging from a few years to a lifetime. Disability policies have two different protection features: non-cancelable and guaranteed renewable. Non-cancelable means that the policy cannot be cancelled by the insurance company except for non-payment of premiums. This gives the policyholder the right to renew the policy every year without an increase in the premium or a reduction in benefits. Guaranteed renewable gives the policyholder the right to renew the policy with the same benefits and not have the policy cancelled by the company. However, the insured has the right to increase premiums as long as it does so for all other policy holders in the same rating class.